So Sigs is based on the bracketed markets, right? And right now, if you look at the bracketed markets, you draw your FVP on multi-day bracket or multi-week. In this case, I think this would be monthly bracket. So it's based on this bell curve, right? You want to make sure that you understand how the deviations work. You have 68, 95, and 99. So what this is showing here, at this time, this was the first standard deviation right here. I think we had, so this one would be your first standard deviation positive skew. Then you have the negative skew, right? And then if you switch this to 95, right, now you would have the second standard deviation sitting right here for that range that you're in. And then you would mark this one as second standard deviation. And as long as I can keep marking them. But remember, this only works, and you want to know about this when it's really in a bracketed market, right? You could definitely look up standard, deviations on a trend, but you're better off using fibs than using that. Now, what you're paying attention to is the probabilities, right? What is the probability that when you're in a bullish market and you're balancing, that you're going to break the third sig here? They're very low, and you see where they're bouncing. They came here, they hit the third sig, they came second sig, and then they bounced really nicely here. So usually when the bracket comes in, whether it's 2 days or 3 days, you want to be 2+ days, 2+ weeks, anything more than one, right? In a bracketed market, you can draw these SIGs and see where are the potential extremes, because other time frame participants come in only when you have advantageous price, right? So when advantageous price is sitting in terms of bell curve, right? So the bell curve is doing this. Then you have your mean, then you have your first standard deviation, you have your second and a third, right? So as soon as you go away from the mean, usually you go back inside and you go back towards the fair price. And that's what these SIGs do.